Welcome to yet another week of Investor's Guide to Thriving. Now, of course, I told you last week that I was having back surgery and that we might not be able to do one this year, and literally was on my way to the hospital when I got a call and said, we've got staffing issues, we're not going to be able to do your surgery today. So that is now rescheduled to next week. So next week there's probably not going to be a webinar, but we'll definitely going to do something, just not sure what yet. So stay tuned for some info on that. But today's talk is going to be very interesting. Obviously, markets have rallied quite timely, and the debate is this a bear market rally or is it the beginning of the new bull? And you know, I would argue it's another bear market rally. And so today's guest, Chris Heeks from BMO ETFs, is an expert on, and he manages some of the ETFs for BMO, and he's involved in the option strategies and looking at the how to reduce volatility in your portfolio. So he's got a great talk for us. And before I formally introduce him, just again, a thanks to our partner companies who help put these together, and of course our educational partner for many, many years in BMO ETFs. So really thrilled to have that partnership. For those of you who have already made donations through the links we provide, thank you very much. For those of you who have not yet, you know, a plea this time of year, which is the charitable season. Everyone thinks about the holidays. We raise money doing these free educational events for cancer research at Sick Kids and for dementia and Alzheimer's research at the Baycrest Hospital and Foundation, both world-class institutions. So please consider that in your email that you get tomorrow and follow up to this event. There'll be some links there. If you click those links to make your donation, we will match the donations up to a total of $25,000. So please do try to double up this time of year. All right, so, you know, I've known Chris for better part of a decade now, and in his work with BMO ETFs, he's one of the instrumental portfolio managers, and you know, can handle some of your questions if you have them that come in. If not, you know, we'll get to them next week or the next one we end up doing, but most certainly we'll be able to answer your questions specifically. But tonight, because I do think this is another bear market rally we're in, Chris is going to make a case for a low volatility approach to markets. So with that, I'm going to dim my mic and camera and turn it over to you, Chris.
Well, thanks so much, Larry, and hello, everyone. It's great to be here, and a pleasure to join Larry as part of this event. Just for a little bit of background, as Larry said, I'm a portfolio manager on the BMO ETF team, and I joined the team in 2011. You know, fortunate to be part of this great industry and, you know, helping clients reduce costs and achieve better portfolio outcomes with ETFs. And one of the strategies we actually started with when I started with the team was low volatility investing. And since then, it's just kind of been a proven way to, you know, get equity exposure to markets and mitigate, you know, the risk inherent in equities. And, you know, as Larry says, has no, you know, I don't think, you know, there's been several kind of volatile times over the years, but obviously today we're dealing with, you know, quite a bit of volatility as we're navigating, you know, this kind of recovery from COVID and inflationary pressures. So look forward to talking about it. So, you know, low volatility investing, what it really is it's a style of what we would call factor investing, or you may also hear the term smart beta. Personally, I prefer the term factor investing than smart beta, but, you know, the both are, you know, essentially interchangeable. You know, what that is essentially to me is, you know, anytime you take a weighting approach that differs from the broad market, and broad markets are typically weighted by market capitalization, so they're weighted by company size. You know, anytime you take a different approach, that's going to be a factor-based approach. And, you know, why would you do that? You know, obviously as investors, we're trying to improve upon that risk and return trade-off inherent in the market. So, you know, as you can see here, you know, over a long period of time, the MSCI World, it's returned, you know, just over 8% a year. with a volatility or risk level of 15. And so that's your return to risk ratio, is 8% return at 15% risk. But as you can see identified in the slides are alternative weighting approaches, that are grounded in economic reason and confirmed by data over a long period of time. So you'll see factors such as value or momentum, dividends, or in this case, we're going to talk about low volatility as tilts within your portfolio that can improve upon that return and risk trade-off. So, there's two ways to improve on the ratio. You can deliver more return, or you can reduce risk while maintaining return. Or in a perfect world, you can do a little bit of both. What we're showing you here is the MSCI, and the MSCI index really showing you get a little bit of added return with a low volatility strategy, but at a significantly reduced risk. And you can see the MSCI low volatility index has a risk level of about 10.5. So almost, a third less risk than the broad market. So, as we move forward on the slide, it can be a really effective tool for long-term investors. And particularly at BMO, we see a lot of clients in these strategies who are perhaps older or have accumulated a nest egg or a sizable portfolio. Still need to have that equity upside but reduce risk. So this is where the strategy kind of fits in. And then in terms of market dynamics, all those factors, it's like different flavors. In different markets, some will tend to do better. So for example, in a heating up market, like in an indiscriminate bull market, you're going to want more aggressive factors like small cap, or perhaps momentum or value. Those factors tend to do quite well. But I think we can agree that we're navigating challenges, and there's inflation, there's slower growth. We're seeing economic signals kind of get a little bit softer, and at the same time pressure on the consumer in terms of inflation. And in those kind of markets, I think it makes sense intuitively. That's when a more defensive approach, like low volatility or dividends or high quality stocks can be beneficial. So let's go to the next slide. And this can kind of make that point in pictures. This is low volatility investing over a long track record. So looking at the US market going back, before that IT bubble crash of 2001, before the financial crisis, and before this most recent crisis of rising rates, inflation, and the impact that's had on growth equities. When I think about low volatility, I think of two features that are really beneficial for it. And the number one feature in a good low volatility strategy is capital preservation. So when times are tough, a good low volatility fund will shield some of the downside. So meaning that the low volatility fund like the ZLB or ZLU are our Canada and US strategies, they go down less than that broad market. And by going down less when times are tough, again, that sets up investors for more success going forward. If you save return, you don't need to shoot the lights out when the market recovers to have that same overall outcome. So to that point, you can see in those dotted circles, in that IT bubble collapse of 2001, that red line, which is the broad market cap index, came down quite a bit. Low vol equities, it was a bit of a nothing burger for them. It wasn't too impactful actually, despite a recession that was caused by that IT sell-off. Same thing 08, and 08 was more, as we remember, more of a systematic event that impacted everything, including low volatility equities. But again, you can see that blue line going down a lot less than the red line. And you fast forward to this year, again, that's that same impact. We know how much technology is in US equities right now. The S&P 500 is about 40% technology. Technology companies have been really impacted by interest rate hikes. So it's an environment that's caused a lot of volatility, and as such, strategies that lower the volatility of the portfolio have outperformed. And, that's certainly what we're seeing, this year. Let's go to the next slide. And, to just put that into, a framework of, upside, downside, like how do you measure the success of these strategies? I think this is something, you look at as an investor and if you're going to try and beat the market, essentially this is the battle that you want to win. You want to have a positive upside to downside ratio. So meaning that you're going to get more of the upside and less of the downside. And really this is what, low vol does quite well. We understand why it outperforms on the downside. They're more defensive stocks, and it's relatively easy. We use beta as a measure, so we use beta to find the more defensive stocks. That reduces risk on the downside. But one thing I'd add in here is something we talk about, the low volatility anomaly. What's the low volatility anomaly? It's essentially that investors tend to neglect boring stocks, if I could put it that way. So in this case, sometimes people are investing, and we've certainly seen it in the last 2 years, whether it's Bitcoin or meme stocks like a GameStop or some of these other meme stocks. Some investors just are trying to hit home runs, and trying to have like lottery ticket home runs. And the problem is when you try and do that, usually you're chasing return. Doesn't necessarily work out. And more importantly, you're neglecting the stocks that do work over time, which are the more stable and quote unquote blue chip and somewhat boring stocks. So, grocery companies, a Dollarama in Canada, Waste Connections, a garbage disposal company, big banks for that matter. These blue chip stocks tend to get neglected. So what you tend to see is higher upside capture ratios for that reason. And that's what really helps low volatility win this trade-off between upside and downside. Let's go next slide. There's a lot of different low volatility products in the market, I'll say, and one thing we always stress in the ETF market, and of course, Larry does an excellent job in terms of education, is a fantastic resource to the overall Canadian investor when it comes to ETF education. There's a lot of different products. One thing we say is, you can come to our website, you can look at the different methodologies. Some use beta, some use standard deviation, some use more of an optimization approach. We were the first to launch a low volatility ETF or fund for that matter in Canada. We launched our first one in 2011 and have since filled out the suite. And we're showing you returns here in terms of the slide, but also paired against risk measures. And what you see is, for example, with ZLB, the Canadian low vol since inception return is over 4% better than the index. And again, the intuitive thinking is, well, you would have had to take more risk to get more return. That's the conventional thinking. But actually, in this case, we've gotten more return by investing in less risky stocks, which has a double win benefit because in volatile times, we've held more value, but at the same time, we've delivered, an excellent return over the long term. The US is another great example of that. This year, couldn't be more stark in terms of some of the market dynamics. The year-to-date return on ZLU is a positive 6%, partially helped by the currency and the strength of the Canadian dollar, but still far, far exceeding that of the S&P 500, which I mentioned is heavily in the tech, area now. So when tech's not performing, and it performed great for several years, but it's not performing this year, it can show you the benefit of having a lower risk strategy. And again, coming in at much lower risk. Let's go next slide. So this is our methodology in terms of how we put together low vol portfolios. We start with a large cap universe, so whether it's Canada or the US. We rank those securities by beta. Beta is a measure of risk versus the index. So we're looking for companies that move less on a day-to-day basis than the index moves. And we use a 5-year metric. One thing that's good about that is a 5-year metric doesn't change day to day to day. It's a consistent kind of number. It evolves as a business evolves, but it does give us a good metric to really assess whether a company is defensive or aggressive or cyclical. So once we rank that universe, then we concentrate the portfolio into those lower beta securities. So in Canada and ZLB, we have 45 companies. In the US, we have 100. We put some sector caps in the construction. We want to make sure that we don't get too overexposed to any one sector, and want to have some balance in the portfolio. But I would describe this construction, the way we do it, is a very pure approach. We start with an index, but we don't just look like an index. We use the index as a place to, select stocks from. But we say, well, we really care about those low beta stocks. Furthermore, the lower the beta a company is, the lower the risk, the higher the weight in our portfolios. So again, when I circle back to what are the promises of low vol, capital preservation, versus broad benchmarks. Well, if you look like the broad benchmark, then when the times are tough, you're going to go down like a broad benchmark. But if you have a differentiated portfolio, you can improve upon those outcomes. And then that second kind of feature of low vol in terms of long-term participation and solid performance of boring stocks. Again, this approach is quite pure and can provide exposure to that. Let's go next slide. And then here's our broad suite of products. So I've been kind of focusing on Canada and the US. We also do have international EFI exposure as well as emerging markets, and we have some currency hedged options as well, and also a US dollar version in the US, the ZLU.U, one of our .U suites. So there's quite a broad exposure there. Now, just lastly, and I'm going to turn back to Larry, is just to dive into the portfolios a little bit. Just wanted to show you under the hood. It's always great, when selecting ETFs to look under the hood and see what comes out. You can see with ZLB, the sectors are quite even, so the Canadian market we know is more concentrated in financials and energy, but if you look at the sectors of the ZLB, the top one is financials, but only at 21%. You'll notice utilities is much higher, consumer staples is much higher, real estate, communication services. So you see a higher weight on defensive sectors. You also see a lower weight on aggressive sectors. So actually ZLB doesn't own an energy stock. And so underweight those aggressive stocks, but despite that, and despite the fantastic year energy is having, is still managing to outperform the index, which I think is great. So it's a very differentiated portfolio. And then you look into that top 10, again, you can see those really blue chip and quite frankly, somewhat boring companies, Hydro One, utilities, insurance, grocers, waste connections, I mentioned, which is garbage disposal and recycling. Really a differentiated solution that, again, can really help investors navigate challenges and deliver on kind of long-term objectives. And then lastly, the US strategy on the next slide. Again, just to highlight the differentiation of this one, again, you'll see those defensive sectors, a higher weight, staples, utilities, healthcare, real estate, higher weight in the defensive sectors, less weight in the risky sectors, and the real, as we know, the biggest driver of risk in US equities is technology, which is, well, IT is 27%, but then you have some other technology companies, that are really, it's about 40% of the index that are technology. And we're really underweight those companies. And you can see the types of names that low volatility invests in, just really simple, down to earth names like Dollar General, Kellogg. So, so Larry, it's not the most maybe exciting segment of investing, but sometimes, as just, being a little more, simple, a little less exciting can still be just every bit as effective. So, I think it's a great tool.
Absolutely, it makes a lot of sense. The construction of my Pro Eyes series of indicators is just telling me now, buy boring. You just have boring stocks, clip your coupons, and we probably have another 6 to 12 months of very challenging markets ahead of us. So, low volatility is one way, certainly. And as we get into the rest of the presentation tonight, I'll look at a few other ways as well to get through what might be a choppy period still ahead. So thanks very much, Chris, and we'll move right into the rest of tonight's presentation.
Yep.
So thanks
for having me, Larry. Take care.
And as a reminder, our educational efforts and BMO's resident on YouTube, and it's on an increasing basis our portal for communicating with our audience. Okay, so on to the rest of the presentation. Three things. Obviously, the Q&A period is pretty standard in all our weekly shows here. This week on BNN, I featured my spin on the lagged effect of monetary policy, and I wanted to dig into that a little bit more in the last couple of days. Some more stuff kind of crossed the tape that I thought was very interesting and speaks very, very clearly to what this means. A couple of Fed speakers came out too and said some things which I want to highlight as well. And then different ways of lowering volatility, including the factor-based investing that Chris spoke about tonight in the BMO educational segment. So let's start off with something that hit the tape earlier today, and you can see the screenshot I captured here as I was putting the deck together, on Thursday morning. And so Jim Bullard, who's president of this Federal Reserve Bank of St. Louis, and historically has been a hawk, a dove, undecided, all over the place, changes his opinion one week to the next. He's one of these guys that historically was labeled a certain way, and really he was the first one of the Federal Reserve presidents to recognize that the transitory language was wrong completely, and went against the crowd probably for 6 months at least before they ultimately realized they were making a colossal failure of common sense with their narrative. Anyways, he spoke this morning, and he basically was focusing on the Taylor rule and talked about how Fed funds might have to go as high as 7% in a worst case scenario. And as soon as he said that, you can see by the red arrow here when he said it, that bond yields, jumped up a significant notch there in a matter of seconds. So, market is very, very hypersensitive. If you want to actually look at his speech, there's a PDF called "Getting into the Zone" that he, every time a Fed speaker speaks at a formal announcement, there's a prepared remarks that they post on their website. So, and the reason I'm moving around is because my back is not great for sitting for long periods of time. So bear with me as I adjust here, folks. And so, Mr. Not Bullard is kind of what he's doing, and the higher for longer, and trying to talk the market out of getting into these periods where you rally because you got a positive data point. And while the Fed is definitely going to slow their pace because that was inevitable, what the terminal rate is higher for longer, and there's going to be some pain, and it's coming still. And so this is not the market environment to celebrate the end of the bear market and to get very bullish, and an opportunity in a rally to get a little bit more conservative, rejuggle, rebalance your portfolio. And so low volatility being the theme this week, fits right in. But I want to highlight what came across my desk this week that really underscores and bolds and italics what this lagged impact of monetary policy is all about, because the lag is here in many, many places. And so there's all these surveys that are done in the marketplace, and one of them that crossed my desk this week featured a builder's survey. So a real estate consulting firm tweeted out, based on the builder survey that he does, basically that in October things shut down completely in terms of home sales. So the data actually came out today. It was weak as expected. The Philly Fed number came out today, and it was dramatically weak. When you look at, the history of Philly Fed, and you project out 6 months what's going to happen to earnings, folks, all the lagged impacts so far, they've tightened very aggressive in a very short period of time. It usually takes a while, but the Fed has never gone this fast before in modern times in terms of raising rates. And literally, October was an inflection point where we fell off a cliff. Now, historically, the markets don't turn until the Fed starts to ease. And the market mid next year is starting to price in that ease. And they're trying to get that narrative out of the market with their bullish, hawkish, higher for longer, terminal rates higher, it could be higher, it could be higher. They don't want asset markets to rally, because that has an impact on the wealth effect. And that's what's going on here. So we're getting the data in real time coming out. People are telling us they're seeing the economy fall, in this case, specifically the housing market. But it's broader than that. When you listen to what CFOs and CEOs say on their earnings calls about sales, costs, I mean, this is the real economy. I don't know to what extent the Fed looks at that stuff, but that's the tire kicking. That's the fundamental analysis that matters far more than anything else. And from a chart perspective, it's the behavioral effect. So Walmart, I basically said in their earnings report that we're squeezing our suppliers, we're cutting costs, and the stock ripped 7%. But what that means is margin pressures are starting to be felt. And so Walmart's response, and Walmart's very unique in this way, every vendor on the planet, basically, not everyone, but deals with Walmart in terms of shelf space. And Walmart generally dictates. Now, for about a year and a half, I had heard from my sources, who I speak to people who sell to Walmart, no pushback, we'll accept it, we'll accept the price increase, we'll accept the price increase, and now it's no more. And that has ripple effects on everybody. So the margin pressures are coming, they're real, they're not able to pass on the prices to the consumers anymore, because consumers are up to here. So there's a link here under this, which is back to the original paper. And it takes time for these hikes to get into the real economy. And historically, the Fed would go very, very slow, measured 25, maybe a 50. They were so wrong last year and so late, and inflation wasn't transitory and it took off. And well, I suppose inflation's always transitory, depending on how you want to phrase it and frame it. But they've had to be so aggressive in terms of what they've done. Now, we'll all know the Fed's favorite indicator is the personal consumption expenditure deflator that's part of GDP. And that's kind of really what we want to focus on here. So when we look at the chart and dig a little bit deeper than the 30 seconds or a minute that I have to explain these things on BNN, we can see that we were in a very elongated, calm period of stable inflation. And we're not going back to that anytime soon, is my belief. Now, what the Fed wants to avoid is the picture of the 70s. So late 60s, inflation starts picking up and the economy's having a problem, and so they start to ease. And it was that easing that spurred the next bout of inflation, along with the oil embargoes. You can throw Watergate in there. There was that recession that hit, and the subsequent aftershocks really had an impact. And they don't want to make that mistake this time around. And that's where higher for longer is the narrative. No, we're not going to cut, folks. We're going to keep it up there. And so the question is, when does the Fed give in? And I think they're going to make a equal policy mistake on the other side and perhaps keep policy tight for too long, so there's too much pain. But the critical thing here is the labor market. And again, today, the weekly initial claims were down. And so we're not seeing broad-based layoffs. It's coming. Whether it's 3 months, 2 months, 1 month, 6 months, 9, that I don't know. I don't think anybody knows. Everyone's making forecasts, of course, but one would have thought we'd start to see some of that already. But generally speaking, people are still having more problems hiring. But you're seeing headlines in lots of different industries, mass layoffs. A lot of that so far is coming from big bloated tech, where the multiples were high, and and that's where you're starting to see it. The real economy, manufacturing, the downturn isn't there yet, but it's got to be coming, because we're starting to see industrial production and the Institute for Supply Management numbers start to come below 50, meaning more production is contracting than expanding. So very, very important. When you look at the breakdown, the core PCE, and you look at the momentum factors of it. So let's do this on the next chart, where you say, here's the current number annualized. Here's the 3-month average annualized. Here's the 6-month average annualized. What you can see is that we've certainly plateaued, but we haven't yet started to contract on any time frame there. And so, this is the key thing that needs to come back down to 2. And the argument is going to be harder to do that. But here's a forecast that came across my desk this week from, is it B of A and some Merrill Lynch. And if you look at the components of CPI, you can see that a year out, they're projecting food to have a very small inflation impact. Energy to be flatlining, basically. So year over year rate of change, again, oil going from 50 to 100 was a huge, move. But if oil is at 100 or 80, or it stays there year over year, there's no inflation. It's still high. It still impacts your dollars, but there's no growth to that number. And then there's your core goods in terms of your sort of raw materials, and that's commodity based lumber and copper and those kind of things. So but where the inflation is going to remain sticky is services, and services are rents, services are wages, a big part of that, versus the materials, versus the commodity piece of it. So that's labor. And so when does that labor picture change? Because that's going to be the leading indicator, if you will, of when the Fed may change and certainly pause. And it's not going to be until that they start to see that. Again, rear view mirror. It's the last thing typically in a recession is the job losses. And so we're starting to hear it. But really in the initial claims data, we haven't seen it yet. And you ask why. It's because when Amazon lays off 10,000 people, they all get a package, 2 months, 3 months, 4 months, 5, 6 months, depending on how long they've been there. And so they can't claim initial jobless claims until that severance is expired. Those are the laws. So there's a lagged impact to seeing that show up in the weekly claims numbers. And so it's coming, but they haven't seen it yet. Now, don't you think the Fed gets this and understands this? I mean, really, think about it. They're very smart people. I don't know. I chuckle and I cry sometimes when you see this stuff. So here's a great graphic. I've shown it over the years before, and it's the New York Fed Recession Probability Index. It's created from a research paper. I believe it was in the 1990s and may have been in the 80s, but whenever it was created, they went back and backfilled the data and basically said, based on the slope of the 3-month to 10-year, so the money market funding rate versus the 10-year, the lending rates, although nobody really lends 10 years, it's more like a mortgage market. But anyways, that based on the slope of the yield curve, what is the probability of a recession? Now, it's a little bit misleading because the yield curve inverted by 500-600 basis points, 3 months to 10 years back in the 80s. And so, by the time this indicator got to that extreme, now, based on the inversion today, it says the probability of recession isn't that high, but historically, the recession is imminent once you start getting above 25 or 30, and we're kind of there. There's a secondary line, this red line here, and that red line is a survey of street economists on what their probability of a recession is, in the next year. And so let's take a look at that. So one is market-based pricing, yield curve, and the other is sentiment-based pricing, i.e. what Wall Street believes. So the current median forecast across, what do you see, 60-something forecast here, ballpark approximately. So, many of them, half-ish, think the odds are higher than 65, and half-ish think it's below, and there's some right on the median. But for the most part, this number doesn't get to 90 until it's there. Wall Street just won't forecast a recession until it's there, because the way the industry works, so that if you're a bear, put up your hand. So everybody accuses me of being a bear, and I'm not a bear. I'm a risk manager, and I look at risk and I talk about risk. And so it's the perception that I'm always negative or bearish, but that's actually not the case. And I'm happy to elaborate if any questions come up on that. But so this is about as high as it gets to virtual certainty. And Goldman Sachs, who we all like to pick on, they're like way at the bottom of this, and they're notorious cheerleaders on Wall Street. their model is based on the markets doing well. So they're very rarely going to tell you what they really think. And Jan Hatzius is an excellent speaker, and he does some very good research pieces. But ultimately, I disagree with his conclusions quite often, because I think there's that element of the street. You're not telling you the full story because there's job risk attached to being too bearish. It's just kind of the way it is. So I think the probability of recession is very high, and this is still another bear market rally, and we kind of gotta use it to get defensive if you haven't already. So Chris tonight showed this graphic, and he looked at the breakdown of ZLB. So Canadian equity, low volatility, and you do get an overexposure, although they've neutralized some of the index, the weightings, but you do get an overexposure to some very boring companies and utilities and things that are generally less economically sensitive and have more stable earnings over time. So no matter what the economy is doing, earnings aren't as variable, and the banks show up in here, but at a lower rate, a lower weighting than the underlying index and some other financials, as you can see there as well. But what I wanted to take another drill down on what Chris showed you is, on a year-to-date basis, looking at ZLB, there are actually some stocks that have done very, very well. And then there are ones that have done worse than the index. And the ones that have done worse are typically, because interest rates have been rising, some utilities that were priced for perfection, some retailers, you see Canadian Tire there, some REITs, interest rate sensitive, and some financials that are very interest rate sensitive. So when you buy ZLB, you get a whole basket. Some do well and some don't. And so maybe you want to take that extra level for you that is more of a stock picker than an ETF person, and just have a look at some of the names. But when things turn at some point in 2023, maybe it's 2024, but some point, out there, that Couche-Tard and Saputo and Dollarama and the defensive names here are actually going to perform relatively poorly to the ones in the low beta category that currently aren't doing well. And so again, lots to unpack there. I get it. The idea here, as always, is educating and trying to help you to see things from a a different lens, perhaps, and a lens with lots of experience in how to do this. Okay, so last year we spent a lot, or last 2 years now, we spent a lot of time educating investors on how to use options as overlays, covered calls, ZPay, and even the Innovator ETF. So again, a link there. They got some great products, and learn how to use them, because if volatility is going to be with us for another year or so, and you're not really a market timer and you don't want to be out on cash, and so have a look at what a year ago the Innovator US Equity Power Buffer ETF did. And so if you look at it, year on year, from that peak in November, equities were down like 20%. So you could see the spider there, and at the end of November would have been, not sure if you can see my marker here, but the little tick there between, I guess October 31st. So when you look at October 31st, and we were down, call it 17%, and that doesn't include the dividend in it. So that was the price decline of the S&P 500. Or sorry, that does include the dividend. So the price decline was probably in the 20% range, where the dividend made it like 17. Well, these buffer ETFs don't earn the dividends that way. And so when you look at it, though, it was only down about 2 or 3%. And so you got that 15% full protection in your portfolio that year. So, and so if you were inclined to, then what you would do is you would sell the power buffer P and OV. There's November and OVP for the power series, and they've got some different acronyms. Again, go to their website and then swap it out at that point and buy the S&P 500 if you believe the market had bottomed. So it's a way to say, I'm going to get the exposure. If we're wrong and it doesn't go down, it goes up, I still get typically up to about 10%, 8-10% upside. So that's great, but it does protect me in my portfolio. And compared to fixed income, a very, very nice outcome in terms of giving you the balance or the hedge or the lower volatility that you would otherwise have liked from the fixed income. But it was an absolute no-brainer, and I rarely pound my fist on the table about something, but I did. Interest rates basically hit zero, in the period post-COVID, and you were not going to get any positive returns out of fixed income for several years. You just weren't, given where interest rates were, and so hence this is the worst year for the 60-40 portfolio, in basically in history. So. Low volatility is an option. Learning how to use these advanced ETFs that have option protection built into them, very good strategy. And we do this in our risk reduction funds that we have for QL Partners and for the public mutual funds we run for Bank of Montreal. So a look at what that means in the terms of low volatility or low beta. This is ZZZD ETF, and all these points are the daily returns of ZZZD versus WDIV. WDIV being the World S&P Global Dividend ETF. So a good comparison to ZZZD that's trying to extract global dividends. And so when you look at the volatility aspect of it, beta is your sensitivity of risk. So Chris talked about ZLB and ZLU having about 30% lower volatility than the world index. Well, the world dividend index beta is 1, right? That's ZZZD, because we use these buffer overlays to lower volatility, had 40% less volatility at a factor of 0.6, over the past couple of years. So that's a good example of looking at how some of these things work. And then finally, a way to protect your portfolio again is now back to interest rates. So long-term bonds have risen, bond yields have risen significantly. The ETFs that I use for long duration exposure in my portfolios, typically TLT, but there's one with even more duration called the zeros, and this is zero coupon treasury, so long-term with the coupon stripped out, so there's even more volatility of price. And so ZROZ is the ticker for that. And you can see over the last year, as interest rates have been rising, that you saw a very significantly bad performance. So where zeros at their worst were down about 47%, it looks like, currently down around 40, where TLT total return down about 30% year on year. That's what the scale is there. So if you believe that inflation has peaked, if you believe that Bullard outside scenario of 7% Fed funds rate is not there and it's really going to be around 5, and they're going to start to pause, then if we're going into a recession, long duration bonds should provide capital gain potential for you and more of that traditional balance. Now, again, the average balanced investor this year is probably down somewhere at this point between, minus 12 if it's really good to minus 18, 19, 20 if it's, again, depending on how that balance is delivered for you in the traditional 60-40 type portfolio this year. And so, again, the year's not up. I think there's more vol coming, but yields are now at a point where they can start to help you if you believe we've hit peak yields. Now, there's all kinds of arguments with quantitative tightening and all the deficits that need to be funded that there's still going to be a lot of stress on the bond market in 2023. And I'm in that camp. So these are tools you could use, but understand, don't just buy and hold them and forget about them. They're active investment tools. So, okay. And we've got a time for just a few more questions, but we're pretty, getting pretty, oh no, we got maybe half an hour left. So let's see what we can do here. Okay, so someone asked about Amazon laying off 10,000 employees. And is this a glimpse into the future for companies? And so I talked a little bit about that, employment being key, and obviously Amazon's a massive, massive company. So Bezos was being interviewed recently, and he basically talked about next week's event, Black Friday, and the beginning of the Christmas sales season. And Bezos is out there telling people not to buy cars, refrigerators, and other big ticket items. Because if we're not in recession right now, we're likely to be in one. Guess what 3 things Bezos doesn't sell to the consumer? Anyways, but he's not right. And so credit card balances, like a colossal number, the biggest annual increase. So Americans are still spending, but they're spending on credit, and that cost of credit keeps going up, and there's just going to be a tipping point. And if you don't think we're going into a recession, Goldman Sachs, I think you're absolutely stuff I can't say in public. But anyways, so just so great question, and the answer is yeah, repercussions. Now, again, does that mean you sell everything and go to cash? No. It means you learn how to switch your portfolio around so that you can withstand whatever ride you're going to get. And I presented a couple of ways to do that tonight. Over the past week, markets have been up across the board. Can explain what's caused the uptick if inflation continues to be such a big problem. Well, I covered inflation. It is a big problem. And the uptick was the positioning. Every CPI report in the last few months has disappointed. So the setup, the narrative was to, front run that. And so it was pretty clear from our pro eyes indicators how deeply oversold and pessimistic the market was, which means there's a lot of cash around, which means if you get a surprise, which we did, that money's going to rush in. And boy, did it rush in, in a couple of days. Does that mean we're good economically? Does that mean the bottom is in? No, it doesn't mean that at all. It means a lot of people were offside. We're into a good seasonal period here, typically through early January. And it didn't pay to be short anymore if the data was going to paint more of a Fed pausing, slowing, stopping narrative for the next few months. And so, markets, and then of course Bullard comes out and says something, to change that narrative a little bit. So you're going to get a lot of Fed hawkish commentary, and the markets are going to remain very choppy. Is gold still a good investment during times of inflation? Is there an ETF you use in your portfolio? So right now, gold, equities, silver, GDX, EGD, SIL, you know, we were selling into strength for the last year and a half, and now we've added. But I've done it by the way of options. I've written a put to buy a call out into March, again around the pause time that we're contemplating. And if we do get that, gold stocks from where we did it, you know, probably 15% lower than here. You know, GDX 35, 37 kind of area. We're currently 27-ish. So, you know, those are some of the tools I use. You get more leverage with gold equities, but to always have them in your portfolio, sure. But the question is how much, right? And if you have too much of it, you know, it could be a bad experience. And we went through a little bit of that in 2020, where we were pretty sure that was going to be a great hedge to the downside, and it just didn't play out that way. And I made a big bet. I was wrong. And so it's, you know, so right now for a trade, it makes sense. And we're doing it in the portfolios where we can with options, and we're just kind of nibbling on dips for a trade set up into next year that way. So what do I think of FTX bankruptcy? You know, one of the things that I detest about the financial business is the character, some of the characters that it attracts that are purely in it for themselves and not for the greater good. And I hope you could see that, you know, my educational efforts and trying to teach people how to make better decisions. I think those are the good things of the financial industry. The fraud, the malice, that is rampant in this space of, hey, I can create this digital nonsense. I can create some kind of exchange. I can make bags of money for them myself and don't really care about the client. Now, again, there's a lot of smart people like Ontario Teachers Pension Fund that obviously did their due diligence before giving FTX $95 million of Canadian Ontario teachers pension money. But where there's a fraud and there's misdirection or whatever. So, you know, when the movie comes out, we'll know more of it. When the books are written, we'll know more of it. But this is the part of the industry that, you know, when people ask me about it, and I say, listen, it's speculative, trade it, you know, realize you're gambling. It's not investable, right? And that to me is the whole thing, because I see it as a Ponzi scheme. And if Andy Bell were sitting next to me, he says, Larry, it hasn't been officially ruled a Ponzi scheme, so we can't call it that. Well, perhaps on the news, they can't call it that, but I can call it that. I think the whole thing is a exercise in anti-establishment. I get the DeFi thing. I get the smaller government. I'm all for getting the government's thumb off of us. But Bitcoin isn't the answer. And so speculative vehicles, stuff breaks, and it's just part of it. I don't think there's enough systemic risk, although there is tangential risk. What I mean by that is if a fund has a bunch of Bitcoin and a bunch of stocks, and they're getting redeemed because people see that they have Bitcoin, then they're going to have to sell some stocks too. So some of that, you know, plays out. But the fraud, the sheer audacity of the arrogance of these people that are running these things, it just makes my blood boil. And, you know, and that's kind of it. So I don't think it's the stuff that, is it a WorldCom and an Enron and that's it? Or are half of these exchanges slash coins slash whatever WTFs they are, that part, I suspect there's more to come. And stress around credit contraction, more of that to come, reveals the emperor's, the kimono opens, as they say. So we didn't see a red wave in the US last week as expected. How will this ultimately affect policy, and what can we expect to see happen? So gridlock, today, finally, they gave the tip of the hat to the GOP in the House. And basically it came out like we forecasted a month ago, where the House would be a slim majority for the GOP. The Senate would stay blue, and we'd have this gridlock situation. But I think that the narrowest of narrow margins in the House, there's just not going to be enough strength that you're going to see anything meaningful. So good from the perspective of less deficit funding, bad from the perspective of when the economy really needs it. Politics are going to get in the way of the 2024 election. And, that in itself for the GOP with Trump involved is going to be a real, if I can say it, shit show. Very entertaining for late night TV. But it's pretty clear in my mind that the former president, should be incarcerated. His best before date is in the rearview mirror, and he's going to cause more harm to the Republicans than good going forward. And that might mean that if the Democrats can put up a credible candidate that pulls some moderate votes, but how strong is the uber left of the party, and who's going to be the candidate? So, we'll see how all that plays out. But it's not a bet we want to make today. So, I think generally speaking, gridlock is good for capital markets. And so that's a positive for 2023. That in and itself might be take out that worst case scenario that Jeremy Grantham talks about, where 23, 24, 2500 S&P, retest of the COVID lows, whatever kind of market next year, and limits it to maybe 32 to 3500 range as another bottom that we need to navigate through next year. So at S&P 3900, 4000, it's not 4500, 4800 next year that we have to think about. Maybe it's a 2024 thing, but I suspect it's going to be 2025 before we see the highs retested again. So we got another couple of years here. I think of choppy markets, and so that and the politics are going to be ever more potent as we hit debt ceiling limits and they debate. Are we at a place in time where it makes sense to purchase multi-year GICs again and begin laddering the process? So sure, there are some great ETFs. High interest savings account ETF, HISA is a great ticker, HISA, one of the better ones. There's cash. There's a few of them. There's a US one. What is it? HISU-U, something like that. Yeah, HISU-U, which is a US dollar version of a high interest savings account. So those can be utilized for cash balances in portfolios. It's going to pay you for sitting in cash. Go to GICs, but the problem with GICs is that there's good and bad. If you need the money for a certain purpose in a year or two, then use them like that. But if you want to place cash and ultimately that cash is going to go back into equities, then use some of these high interest savings ETFs to get a decent yield into your portfolio. And that when the opportunity does develop, you're not locked in on your GICs. So again, depending on your need there, I would say yes, and I would say no, depending on what your use of funds will be on the other side of those GICs. This is a good time to invest in real estate and REITs with the housing market dropping. So REITs generally have nothing to do with housing, except for apartment REITs. And so it's retail, it's office, it's commercial. I featured a couple of weeks back Bernardo and Boston properties, and those are two REITs we would probably take a look at now. So let me just bring up a chart here. A BSX. No, it's Boston. What is it? Boston properties. BXP. And just let me do a GPC chart. So I had highlighted them kind of down here, and it's NVIDIA. XP. There we go. Okay. So let's look at a very long-term history. So I clicked my max button here, and you look at Boston properties and go back, looking at where it's trading. Like, basically we're at the lows of 2020, but you can go back to the great financial crisis. So Boston properties, slightly different exposure. Vornado REIT, VNO. If you've gone to New York, every third building is run by these guys. And again, go back and look at history and say where are office properties valued. And so are we ever going to go back to normalization? So, and so when you say, is it time to buy REITs? You can dig in a little bit to which kind of REITs. And office to me is looking kind of interesting here, to buy on pullbacks. I think there's some tremendous value. So, but maybe not everywhere just yet. And our last question of the evening. What is the outlook on commodity stocks as we head into 2023? So commodity stocks, that's a broad question because we have metals, we have energy, and so let's have a look at a couple here. In fact, let's bring up my earnings chart here and let's get ExxonMobil. Okay, so big US. It's you're not early. The stock's trading here, so let's kind of go back and look at some history here. 2000. Well, let's go back to 2006. So we get the great financial crisis. We get the spike in oil back then. Okay, it didn't like that. 2006. Come on. There we go. So given where oil prices, ExxonMobil, compared to the other peaks in oil, I gotta say, I don't like the value here. So depending on what in commodities, big, large cap energy companies, to me, don't like them at all. At all. Now, if ExxonMobil got back into the 80s, yeah, then there's some relative value there and kind of look at it. So, you know, and it wouldn't be that different if we put, you know, a Suncor in here and looked at that. I had picked on this stock a number of years ago. I was saying, oh, here's a stock that if you own for the last 20 years, you made no money on. And so, you know, a lot of commodity-based stocks demand to be traded. You know, unless they're junior growers, but these mature ones, you got to trade them. You can't own them. You can like the dividends, but there's just no growth profile to any of these energy stocks. Like this, the best is in the rearview mirror. It's clear by looking at these charts, right? It's so painfully obvious. I get the stories now. I get they might be good for a couple of years here, but right now, not attractive to me whatsoever. But you know, so let's have a look at you know, Barrick Gold. I'm looking at the US one here versus the ABX ticker. You know, and so, you know, here's, remember, gold made new high in here. Here's the highs. So, you know, there is tremendous value and long-term potential in some of these stocks in the precious metals side right now. And again, you know, you look at Hecla Mining, you know, as a silver play. This is a go-to name, you know, for hedge funds. I like it. I own it. I own a lot of it in my stock portfolios now, and you know, I think we're going to pop back up into the upper end of the range, and at which point I won't like it anymore. So you know, Hecla looks very interesting to me. Let's look at some of the base metal names. You know, copper, Freeport, McMoran. I know they do a bunch of other stuff. Probably Lundin is probably a better copper play. So some of the base metals, you know, they had corrected quite a bit. They've had a good bounce here. So not as good value here as they were, you know, at the recent lows. But if we're going to go into a recession and get a pullback, then, you know, you start to like some of these base metal stocks, the coppers, some of the aluminum names. You know, a year ago, these things were, looks, you know, breaking out, whatever, and now it's crazy. Look at the analyst targets, chase. The analysts get it wrong all the time. So now they're very negative on it. What's going to happen? Anyways, I like some of these base metal names here too. I think there's some good value in them as well. So, you know, robust economy in 2023? No. Does it make sense to have base metal stocks if we're going into recession? No. So the question then is, how much of this has already priced in that downturn? Anyways, that's enough for me, folks. My back my leg, sciatica is killing me. I got to get up and move around here. Anyways, thanks so much for being here. Remember, have a look at one of our companies. If you need help with your portfolios, you need some consultation, whatever it is, looking for more education, there's plenty of stuff out there. And again, if you want to thank us, please do so. Click one of the links in the email. We'll follow up. Cancer research at Sick Kids and dementia and Alzheimer's research at the Baycrest Hospital and Foundation. Have a great week, everyone.